So, you're thinking about investing in tech stocks. I get it. You hear about all this incredible innovation, these massive returns, and you want in. But let's be honest, it can feel like a really complex world with a million moving parts. So, we're going to break it all down and create a clear guide for navigating it. Okay, first things first, let's just get a sense of the sheer scale we're talking about. The tech sector has a market cap of around $19 trillion. To even try and wrap your head around that, that is bigger than the entire economy of many, many countries combined. This isn't just another part of the market, it's a huge foundational pillar of the global economy. It's where so much of the action is. And this right here, this chart tells you exactly why everyone's so focused on it. Just look at that performance. Between early 2017 and mid 2025, the tech sector rocketed up nearly 442%. The S&P 500 did great, but tech nearly tripled its performance. That kind of outperformance is exactly why you hear about tech stocks everywhere. And it's really no surprise, right? I mean, think about it. From the phone you're probably holding right now to the software that runs pretty much every business on the planet, tech is just everywhere. It's totally woven into the fabric of our lives. And companies like Apple, Microsoft, and Nvidia, they aren't just leading the market. They are literally building what comes next. The potential here is just undeniable. So the real question is, how do you actually approach a sector this powerful in a smart, informed way? Well, let's break it down. So let's start with the big why. What is it about tech stocks that makes them so popular, so exciting for investors? What's the big allure? It really boils down to a few key things. You've got that incredible potential for growth and that proven track record we just saw. But it's also something bigger, right? It's the feeling of being part of this constant world-changing wave of innovation. It's about investing in these influential leaders who feel like they're personally shaping the future. Okay, but with that incredible potential comes some pretty significant risk. And it is absolutely crucial to go into this with your eyes wide open. So let's get real and talk about what you need to know before you even think about diving in. Look, any kind of stock picking has general risks, like putting all your eggs in one basket or making decisions based on fear or greed. But tech has its own unique set of challenges. We're talking about sky-high volatility, absolutely fierce competition, and a regulatory landscape that's changing all the time. And wow, this chart right here just perfectly illustrates that concentration risk. At the time of this data, just 7 giant tech companies, what people are calling the Magnificent Seven, made up about 30% of the entire value of the S&P 500. Think about that. If even one of those giants stumbles, it can shake your whole portfolio. So how do you cut through all the hype and figure out what a company's really made of? This is where your analysis toolkit comes in. Let's open it up and look at the essential tools you need to get under the hood of a tech company. At its heart, fundamental analysis is all about studying a company's financial DNA. It means you're not just looking at the stock price. No, you're digging into the numbers that actually drive that price. Things like revenue, earnings, cash flow, to figure out if the company is genuinely strong, if it's fairly valued, and if it's actually built to last. Okay, one of the first concepts to get is liquidity. And it's simple, really. It just asks, can this company pay its bills for the next year? That emergency fund analogy on the slide is perfect. For a tech company that has to move fast, having enough cash on hand to survive a downturn or jump on a new opportunity is absolutely vital. And there are 2 easy ways to measure this: the current ratio and the quick ratio. Think of the current ratio as a good general health check. The quick ratio, though, is a bit more strict. It's more conservative because it doesn't count inventory, since, you might not be able to sell a warehouse full of gadgets overnight. Now, let's zoom out and look at the long-term picture. That's solvency. It measures a company's ability to handle its big long-term debts. So if liquidity is that short-term emergency fund, solvency is about its ability to handle a massive mortgage and still be standing strong years from now. You can check this with ratios like debt to equity, and yeah, as a general rule, lower debt is usually better. But here is the single most important thing to remember. These numbers mean nothing in a vacuum. You have to compare a company's ratios to its direct competitors. A certain level of debt might be totally normal for a fast-growing software startup, but a huge red flag for another company. Context is everything. But hey, a company is so much more than just a spreadsheet, right? The numbers tell you where it's been, but the other stuff, the qualitative factors, that's what can tell you where it's going. And that means we need to look at who's in charge and what's happening in the news. This quote really says it all. You have to ask yourself, who is steering the ship? A visionary leader who has a proven history of actually doing what they say they're going to do? That can be a company's single most valuable asset. It's what inspires innovation and earns the trust of investors. And staying informed, that's just non-negotiable in tech. You've got to keep up with financial news, listen closely when companies talk about their own future earnings, and definitely make use of those awesome news tools that most brokerage platforms have built right in. All right, we've talked about the why, the risks, and the tools you need to do your homework. So now, let's put it all together and build a smart, resilient strategy that's designed for the long haul. We can really boil this down to a simple 3-step game plan. Number 1, diversify. Don't put all your money on one hot stock. Spread it out. Number 2, think long term. Try your best to tune out the daily noise and focus on where you want to be years from now. And number 3, which is kind of funny, is to leverage the amazing technology that this sector creates to help you stay disciplined. When you get right down to it, it is all about balance. The goal is to capture some of that incredible growth potential we saw at the very beginning, but to do it with a disciplined, diversified, long-term strategy that can weather any storms that come your way. Because in the end, the tech sector isn't just another place to invest your money. It's the engine that's literally building our future. So the only question left is, what role do you want to play in it?